Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. Chris and Jason here from Hard Money Bankers. As always, sponsored by hardmoneymastermind.com, our community for private and hard money lenders. Go check it out, create a free account, hardmoneymastermind.com. Today we are answering some Mastermind members' questions. There have been some good ones inside the Mastermind that we do answer, on basically a daily basis. We're scrolling through there and chiming in and offering whatever help we can. But there are some things that it's easier to expand on in this way, right? Like talking about audio and video as opposed to just typing it out inside the Mastermind. So we're going to do a couple of those today. And keep in mind, guys, this is how we run our business. If any of these things touch on like legal or tax or financial issues, make sure to consult your own professionals, your attorneys and accountants and everything else. That being said, yeah, let's jump in.
Good disclosure, Chris, and more importantly, like there's a lot of people inside the Mastermind group that sometimes have conflicting thoughts or views based on how they run their business, and that's fine. The best part about this private world, hard money lending world, is there's lots of different ways to do it. So do it the way that fits best for you, and we're happy to discuss the way that's worked great for us over the last 16 years. So the first question is from Tyler: How to efficiently use investor capital without the use of a fund. Ways to optimize co-lending processes or the sale of a whole or fractional note at closing or after closing. So in essence, meaning if I don't want to use a fund, how else can I structure these loans with my co-lenders?
Okay. All right. A few things here. So let's break down quickly. Won't spend too much time on it. The basics of co-lending. In essence, what that means is, and this has different names like direct placement, you could call it fractionalized notes, trust deed investing, stuff like that. It basically all means the same thing. And that's in our setup, how we structure it is that we close any loan in our company's name, Hard Money Bankers name, and then we assign it to the investors involved in that loan. So like, let's say it's 25% Jason's account, 25% Chris's account, and then 50% another investor, right? One of our co-lenders. And we do the assignment documents, we notarize them, we send the originals to our attorney to hold. All of our co-lenders who have been around for decades or more now have the information, they know the structure, and the software we use is set up to deal with that perfectly. So if we're lending at 12.99 and my account and Jason's account is going to get 12.99 because we don't charge ourselves servicing fees, and then there would be a 2.99% servicing fee charged to that other 50% co-lender in that particular deal, and they'll get a flat 10%. If you're in Mortgage Automator or the mortgage office like we use, it's set up to handle this perfectly. Now, if you're doing spreadsheets and QuickBooks, you just do the math, right? And so that you know how much you pay out to yourself as servicing fee and how much you pay out to the investor, to the co-lender. And that is the standard way of doing this without a fund. So we're not going into the description of a fund because that's not really what this question asks. But one thing I do want to point out is that I don't know if it was in this question in the Mastermind group or in another thread, but some people borrow unsecured money from capital investors and then lend it out into their own deals. We've never done that. You can do that if you want. I think there are some potential drawbacks to that, like signing personally for the money, or whether or not borrower A makes this payment this month, you still have to pay out to the investor because they're not tied to that deal. For those reasons, we don't really recommend doing it that way. You don't have to. And so in essence, like they're a lender along with you, and that's whether or not you're in the deal yourself or not. It works the same exact way, whether it's 3 investors who are funding a deal or 1 or 2, whatever it might be. Even if you're not involved, it works the exact same way.
Yeah, no, all very, very good points. And I think the part of the next question with Joe asks 2 questions that we'll talk about both of them. But I think the second one had to do with, do you raise money for each deal, or do you raise money through a fund and then you lend it out. But we'll go through that. Yeah, all good points. And like Chris said, we typically like the direct placement model. Again, that's just kind of what works for us. There's lots of members in our mastermind group and in our inner circle that do it differently. Some have a fund. That's just the way that's always worked well for us since we started. So Joe's first set of questions is, how do you start? Do you raise the money first or get a deal first? I think that's what that means. If it's something beyond that, a little bit more basic of like, how do you get into private lending? Hard Money Mastermind and listen to Private Lenders Podcast is a very good resource to get started. Obviously, there's 3 elements. There's access to deals, opportunities, borrowers, clients to lend to, investor capital, either your own money or other investors' capital that will be lending it out, and also the know-how and the knowledge in order to operate a lending business. But in our opinion, it's always about a deal. A deal's coming first. What's the biggest problem that high net worth individuals or wealthy folks that have disposable capital to deploy need? They need opportunities to deploy their capital into. Good, safe, high return opportunities. So if you have deals, good deals, good deals, I'll emphasize that, right? Everyone thinks they have deals, but like good opportunities, good deals, that comes first, and then the money typically will follow. Now, that being said, that doesn't mean you don't have to go out and start raising capital if you don't have any capital at the beginning, but you can raise all the capital you want. And if you don't have good opportunities to put it into, or even if you put it into deals that aren't good deals and they fall apart, that capital will eventually dry up.
Yeah, let's go into some more detail on this one, because this is an important question. It's a never-ending thing in this business. And in essence, it's a chicken or the egg situation, right? Like, which one comes first? Okay. So there's a difference between raising capital and having capital ready to go for a deal that comes. And let me break down what I mean by that. So one, you should, prior to putting out a term sheet and committing to fund a deal, you should have some warm capital in your orbit, if that makes sense. Some people who you have connected with. So you have some leads on capital, right? Some people who you have connected with, explain the business model, explain your deals. Here's why it makes sense. And they, in principle, agree that they're into this kind of investment that looks like this. That's something you're going to need to do. Now, I don't want people to get stuck on that. I don't want people to say, oh, I can't take in any leads on the borrower side because I don't have all this capital available and ready to go. Because then you're just going to put yourself in a position where you never do it. At some point, you're going to have to commit to a deal, put out a term sheet, and commit to lend on the deal with these terms. And then you, as you're underwriting, there's a whole process for this, and I can't go through every detail of it right now. But at that time, when you're underwriting, you circle back with the capital investors, those warm leads that you have over on the sideline, and say, I have a deal. Here's what it looks like. Let's take a look. This is a deal. So it's really the chicken or the egg. Like, I don't want people to get stuck into a position where they say that, like, I can't quote any deals because I don't have all this capital, because at some point you're going to have to quote a deal and you're pretty sure the money's going to be there. You may not be 100% sure unless it's your own. But at some point you have to make that leap. That's part of the business. And the reality of this is that this situation goes on forever. Now, does it get easier later on as you have capital investors who have funded many deals with you to pull money off the sideline and into a new deal? Yeah, it does. It does. But at the same time, even today, like 16 years in, like I will sometimes take a look at our pipeline if we're having a big month and be like, that's more than we have in escrow in terms of investor funds. So I'm going to have to pull some money off the sideline. Okay. So it's always that juggling act. It's always that balance. And it's just always going to be that way. And that's okay. It's not a bad thing. I mean, it's a great business all around. So if that's one of the tricky parts about it, so be it. We just accept that that's part of it.
All good points.
Yeah. Yeah. So I'm just looking at Joseph's question again. How do you start to raise money or get a deal? Yeah. I mean, that was a long-winded answer for it, but I think that as the operator of a private lending company, you should be doing both all the time. You should be always getting leads for potential deals to fund, and you should always be slowly raising capital.
Yeah, good point. All right, let's do one more question for this episode, and then we promise we'll do a follow-up episode because there was more questions that came in the mastermind. If you're not in the mastermind, make sure you check it out. Obviously it's free to join. hardmoneymastermind.com. That's where we're pulling these live questions from, and as they continue to come in, we'll continue to do other episodes, but we definitely will be able to do one other follow-up episode next week because there's still a handful of questions here that we want to definitely make sure we get to, because that's important to us to answer everybody's questions. So last question, can you break down what's the breakdown of costs your borrowers are seeing at closing? I've had borrowers say, quote, "I'm not paying that much to have your attorney draft a promissory note. What are industry standard amounts that borrowers pay?" So let's start off with what we have in ours, and we get very little pushback. So you can use that for reference. So we're at 12.99% interest rate in 3 points. So in essence, 13% in 3 points. We have a $9.95 commitment fee, call it a commitment fee, funding fee, processing fee, underwriting fee, call it what you want. That's just the way that's how we have it set up. We call it a commitment fee. Very, very little pushback. Pretty much no pushback. There's a few repeat borrowers that we've done, handfuls of deals for, dozens of deals for over the years that we give a little break on. Sometimes we'll do $500 at a $9.95, but I mean, very little pushback on that. So, and our average loan amounts, just in context, is $200,000. So it ends up being a half a point. So it's a big profit center. It's important. We charge $400 upfront to do an inspection of the property, where we send out an inspector to the property to confirm the construction and analyze some comps and things like that. That is a full-time person that works in-house. But when we started, for the first multiple years, we had real estate agents and other real estate investors do that for us. Not going to go fully into detail about this, but in essence, like, their job isn't necessarily to make an underwriting decision. That's your job to make an underwriting decision. But we do send somebody out to the property kind of on our behalf just to double check things and the condition. So we charge $400 for that upfront. It's super important to make sure you're collecting that upfront from the borrower, right? If they ask, the industry is like, well, what's your application fee or upfront fee? That's not an upfront fee, right? That's covering the cost to send an inspector out to the property, just like ordering an appraisal if you're in the conventional world or the institutional back lending world. And if they send an appraiser out, it's $550 or $650 typically. So it's cheaper than using an institutional capital source in that means. But not only does it cover your cost, it also makes sure the borrower or the client has a financial commitment to proceed with you with your loan terms. So it's super important. We get that $400 when they sign the term sheet with us. We also have a $195 inspection fee, draw inspection fees. So depending on how many draws we do, like I just sent a term sheet out 5 minutes ago before we started this podcast, and it was a $50,000 construction holdback. So we did 4 draws, $195 a piece for inspection fee. So that's all our lender fees. And then our attorneys charge $750 to do a loan doc package. And our loan doc package is pretty intense. There's promissory note, deed of trust or mortgage, assignments of rents and leases, guarantee agreements, everything. It's a very professional package. They charge $750. That goes to them. And I don't know, it's 60 pages or something like that. So related to loan costs, obviously there's lender's title insurance and stuff like that. That's what we have. And I think for the most part, it's pretty standard. If you actually go look at institutional back lenders, some of their stuff's more. Their legal's more, their processing fees are more. It might be broken up a little bit differently into different sets of fees instead of one fee, but theirs are actually a little bit more. The mom and pop, real mom and pop, hey, I'm a private lender, and I invest through my self-directed IRA and, I do everything in-house type of thing. They might get an attorney to do a boilerplate doc set form for $250. But the way that we have ours set up, we lend in 6 states. We've worked with a lot of other consulting clients and other hard money lenders in a lot of different states, and they're all about the same as ours. And that seems to be pretty standard.
Yeah, you're safe in between 500 and 1,000 in residential lending, right? Commercial's different. But yeah, I don't think you should get much pushback on that. If somebody wants to complain about that, it's like, so be it. But that's what they're going to charge, and that's normal. And also, just to add a little another detail to what Jason explained before, is that you're going to want to disclose all this stuff. The same things that are going to be on a settlement statement, you're disclosing this in your term sheet. Like, you have a term sheet, and then we have a cost breakdown, which looks very similar to what a settlement statement is going to look like. Obviously, it's an estimate because we're estimating like property taxes and transfer taxes and stuff like that we don't know the exact numbers on. But it's important for the borrower to see every cost that's going to go into this and the final cash to close number, and sign that document, and then pay you the $400 for the inspection, right? That's the process right there. And it's important to do that. And I think that was part of what Tyler was asking, is that there shouldn't be any surprises at closing. Like, they are signing off on these numbers. These are our estimate. It's going to look very similar to the settlement statement that comes next week at closing, and it should all match up. There should be no pushback. There should be no questions at the closing table at all.
Dude, very good point. Because I know a lot of lenders, a lot of them in this group, that aren't doing full disclosures of what the actual breakdown is. You need to know what the transfer and recordation taxes, if they are on, any prepaid property taxes, builder's risk insurance policies that are getting collected. That's very important for you to do. The last thing you want to do is tell a borrower they need $40,000 to do the deal, and they need $48,000. That'll piss the crap out of them.
Yeah.
And also, going back to where this whole started, imagine getting capital lined up from an outside source and then the deal falling apart at the table. That doesn't make you look good either. So, and this comes with experience, right? Earlier on deals, if you're just getting started, makes it challenging, but yeah. And again, don't feel, the markets are changing, and there's a lot of demand for private capital and hard money, and short-term rates have gone up. So the institutional capital rates have gone up a lot. So, this is the industry standard. And if it doesn't work for the borrower, move on to the next one.
Yep. I think that's it for today, answering Mastermind members' questions. We'll be back soon to do some more. And in the meantime, go check out hardmoneymastermind.com, create a free account, and we'll see you next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.